It finally happened. NVIDIA reported earnings. After being down 2% on the day, the stock is trading around a lot, but it's now down 5%. What is going on with NVIDIA's earnings? We'll be taking a look at the full numbers here, giving a breakdown segment by segment and why the stock is going down even though NVIDIA beat on both the earnings per share and the revenue. Salesforce also reported today. This is one of the companies I own. It was down 2% on the day, but after the report, the stock has shot up 3.5%. We'll be discussing what's going on with Salesforce. And then finally, we have CrowdStrike. Like the other ones, it was down 2% on the day, but the stock is having a nice bounce as well, up 3% after reporting earnings. CrowdStrike is being sued by Delta Airlines. We'll get an update on how that's going. So we'll be going over all three of these earnings reports, taking a look at how these companies are doing, and we have some other news to discuss as well. Mark Zuckerberg recently apologized in a letter to the House Judiciary Committee for censoring certain information regarding COVID. The Telegram CEO was arrested in France on charges of online criminality. This has caused an ongoing debate of what type of responsibility a platform has or doesn't have to be transparent with what their users are doing. And then finally, the Peloton's former CEO that was once a billionaire now says he's lost all of his assets. He once had a $50 million home that he's now sold. He has lost his wealth with the crash of Peloton stock. And there's a lot to learn in this story. We'll be looking at the downfall of the Peloton CEO. So we have all of that to get into, plus much more. We'll be looking at my portfolio and how these earnings have affected my performance. Now let's first go ahead and jump into the headline news here. NVIDIA just reported earnings, and so far the stock has been bouncing around up and down a little bit, but overall in the red. In the red from anywhere of 3 to 5%. And this is a different reaction than what we've seen from NVIDIA, especially because it's down 3% after beating on the earnings per share and revenue. The earnings per share were 68 cents versus 64. Revenue was 30.04 billion versus 28.7 billion. Even in the expectations, NVIDIA beat again, saying that they're expecting 32.5 billion in revenue versus Wall Street estimates of 31.7. So to summarize this quarter so far, NVIDIA beat on the top line, they beat on the bottom line, and they beat in their expectations. All around, this company beat every expectation that was on paper, and the stock is still in the red. Now, what does this mean for the stock? First of all, things could change. They still have the earnings call. There could be commentary that could change the sentiment of investors. But I doubt it's going to change that much. NVIDIA will likely trade down a few percentages, or it might trade back up close to level. Either way, this quarter is one of the first quarters of NVIDIA not moving into the positive by a huge amount. On Qualtrim, we have the most recent numbers, and we can look at a revenue breakdown of NVIDIA. If we look at the growth overall, we can see that the company grew 123% year over year, which is just incredible. But if we break down the different segments, we can start off with automotive. This is their smallest segment. This grew 36%. It's good their automotive segment's doing well, but that's only a couple $100 million. We look at professional visualization. This grew 20%. Nothing notable there. We look at the gaming. This grew 16%. Nothing too notable there, and it looks flat over the past 3 or 4 quarters. But then we get to the data center, and here's where all the growth is really coming from. NVIDIA grew their data center business to $26.3 billion. This is a 150% increase year over year. So they beat their expectations, but we still get a muted response from investors. So what does this mean for NVIDIA? Why are investors becoming less enthused about this stock? Why is it trading down when they beat on every metric possible? I believe it's because NVIDIA is now getting to a point where the difference between what they're reporting and the expectations are becoming closer and closer together, meaning that the alpha in the stock is becoming more and more narrow. The earnings reports are becoming more muted. Expectations of NVIDIA are now so close to what they're actually reporting that it's difficult to find as much upside. And this is a natural case for most stocks. NVIDIA went through a parabolic surge in demand, but that demand was not going to be parabolic forever. Anytime you see these type of charts, they never go on forever. It just doesn't happen. At a certain point, there's going to be massive deceleration. Things will start to top out, moderate, and slow down. And we're seeing that with NVIDIA. 1 month ago, I published a video with the title, "The NVIDIA Bubble is About to Pop." Now that's a bit of a juicy title. I may have oversold the video, but the entire purpose of that episode 1 month ago was to outline the situation that NVIDIA faces and how they're now facing a massive uphill battle. When I observe the different situations that stocks are in, and the ones that do really well, and the ones that do poorly, the ones that are in the situation of doing really well have accelerating revenue growth. They have accelerating earnings per share growth. They have expanding margins. They have low starting valuations leading to multiple expansion. That is the perfect situation for a stock. If you can find a company that has all of these qualities, odds are it's going to go up, and in most cases, it'll beat the market. Of course, the perfect situation is difficult to find, but that's the 4 major characteristics. On the inverse, we have the worst situation: decelerating revenue growth, decelerating earnings per share growth, margins compressing, and with a high starting valuation that's more likely to lead to multiple compression than expansion. If we rewind time 3 years ago, NVIDIA was in the best situation. The stock had accelerating revenue growth, in fact, massively accelerating revenue growth. It had margins expanding, and it had a low starting valuation. Everything was set up perfectly for this stock to explode. But now we find ourselves in the inverse. You can see that the revenue growth is not exactly accelerating, it's holding a bit steady, and it's starting to slow down a little bit. This chart is such an uphill battle for NVIDIA, because while they have 150% revenue growth today, as the quarters go on, and they don't grow quite as fast as they used to, the comparables, the year over year, is going to get slower and slower and slower. That is the definition of decelerating revenue growth. And they have the same issue with earnings per share. As the quarters go by, the earnings will grow at a slower rate, causing the stock to decelerate in its earnings per share growth. And the margins are already so high for the business, they also have nowhere else to go but down. They started with a 78% gross margin, which is down 3% quarter over quarter. So I don't say any of this to bash NVIDIA stock. I think it's one of the most incredible companies in the market today, and it's one of the most amazing stories over the past 5 years. It is incredible what they've accomplished, but it is the conclusion of almost every story that's experienced this parabolic growth. It just doesn't go on forever. These type of charts don't continue in perpetuity, and you can't extrapolate this growth into the future. At some point, these growth rates will come down substantially. NVIDIA will have difficulty growing year over year. Now, it may be slightly above or below what investors are pricing in, but we can say definitively with this report that the upside in the stock today is far less than it was a year ago. The future expected returns are far lower. NVIDIA will trade closer to expectations, and it'll be harder to get gains out of this company. So what does it mean if we have more moderate growth expectations and earnings from NVIDIA in the future? What if it trades a bit more in line with every other company? What if we don't see this company double and double again? Well, that helps out individual investors, specifically ones that don't hold NVIDIA in their portfolio. So far, this portfolio has outperformed the market for the past 3 years on a time-weighted basis. Now, this year is a close race between my portfolio and the S&P 500. With NVIDIA tapering off and now no longer in and of itself pushing the indexes up, that makes my job easier as a stock picker when I don't own that company. The relative performance of this portfolio should do better if NVIDIA is no longer pushing the market higher. So all it does when it cools off a bit and grows around the same pace as other companies with your 5 to 10% gains, that makes my job easier as a stock picker. Now, one of the companies in my portfolio, in fact, the only one that I'm currently in the red on, is Salesforce. And this is also one of my most recent buys. My total position size is $56,000 with currently $4,000 in the red. So this one has been a red so far, and I've said repeatedly that I think this is temporary. Over time, I believe the earnings growth and the free cash flow per share growth will push Salesforce back into the green. Salesforce just recently reported their earnings, and the stock is currently up 3.3%. The earnings of Salesforce can be best summarized by a tweet from the CEO, Mark Benioff. He goes through the most important 3 metrics of the company. First of all, the revenue growth. You can see the revenue growth every single financial year from 2014 up until 2024. The revenue went from $31.4 billion to $34.9, and the guidance was $38. It is a lockstep move upwards and upwards for the revenue of this company. We can take a look at the margins. The margins are a clear indicator of the moat and pricing power of a company. If a company raises its margins year after year after year while growing revenue, that is a strong indication that the company has a wide moat. And we see that with Salesforce. From 2020, it was 16.8%. all the way up to 30.5% in 2024. We can look at the operating cash flow. It goes from $7.1 billion in 2023 to $10.3 billion in 2024. The guidance so far is $12.8 billion in 2025. Now, Salesforce is down 2% on the day, but up 3.5% after hours. And I believe the reason that the stock is trading up after hours is because expectations for Salesforce have remained rather low. Investors aren't too excited about this company. They don't view it as a big AI winner. They view it as a victim of AI, a company that's going to be engulfed or beat by AI companies. I see things differently, and I think the numbers prove that. The revenue breakdown shows that Salesforce is growing once again in every category. Overall, the company grew 9.47%. If we cross out the other segments and look at the Sales Cloud, that grew by 9%. We look at Service Cloud, that grew 10%. We look at the Platform and Other, that's things that have to do with the developers, that grew 9%. We look at marketing and e-commerce. Those are tools to create your own online websites and different things with Salesforce. That grew 5%. We look at integration and analytics. That grew 13%. Salesforce has deep integration and concentration of market share with every one of these segments, and all of them are contributing to the overall growth. The other important metric, and one that I believe investors are looking at today, is the total performance obligations. This shows the total number of dollars committed to be spent on Salesforce that are beyond a 12-month contract. So if a company signs a 2-year or 5-year obligation, it shows up here. It was $53.5 billion in the last quarter, which is almost a 16% increase year over year. So even their obligations, which is a form of deferred revenue, is increasing. The free cash flow that Salesforce generates continues to increase, and this last quarter was no different. It was a step up from the same quarter 1 year ago. If we zoom into the past 3 years, we can see this more clearly. 1 year ago, they generated $628 million in free cash flow. This quarter, they generated $800 million. So we have a nice increase of around $200 million in free cash flow year over year. And all of that is adding up to explosive free cash flow growth. So I don't know what to tell you. I look at Salesforce and I see everything going well at this company. I see organic revenue growth. I see share buybacks. I see free cash flow growth, substantial free cash flow per share growth. Even when we look at some of the red flags for the company, or some things that people are concerned about, like the stock-based compensation, that is not as big of a concern as it used to be. We can take a look at the trend and it's going down year over year. So they're getting a greater control over their expenses, and they've said that stock-based comp will never be above 8% of revenues. And all the while this is going on, the valuation still remains rather low for the company. It's a much higher free cash flow yield than most tech companies, and a lower PE ratio for comparable companies. I like the earnings report so far. I see no big red flags with it, and I still believe that the free cash flow per share will ultimately push this stock back into the green. We can already see that happening a little bit after hours. Now next up, of course, we have CrowdStrike. The company was down 2% on the day, but they also reported after hours, and the stock is currently up, bouncing around plus 2%, around that territory. They reported a slight beat on earnings per share and revenues, so they checked those two boxes. The revenue growth was 32% year over year, which is very strong growth, and that is organic revenue growth, coming in from their current customer base or new customers, selling more products to them or raising prices. Of that revenue, the huge majority of it is annually recurring revenue. So CrowdStrike has a really good revenue profile. Now, of course, they have to face that mishandled content update, which caused an enormous outage and billions of dollars worth of damages to other companies through lost revenues and upset customers. So George Kurtz, the CEO of CrowdStrike, is going to have to go and explain to investors and give a positive update. And if I was to guess, I think it's going to be better than expected. I think on the phone call, investors are bracing for the worst. They know that the company's under distress. It has a very stressful situation they're facing. And I think any positive momentum, any positive news on that front will be viewed very favorably by investors. So I'm not shocked to see that the stock is up after hours. I think investors were bracing for the worst here. The stock was down 20% into earnings, and I think that investors are quick to forget large blunders like CrowdStrike's. George Kurtz is going to be doing media rounds. Tomorrow he's going to be on Mad Money, giving Jim Cramer an interview and explaining some context and updates into what's going on. So I think he's doing a good job with public relations, getting in front of investors, trying to be transparent with how the company's doing. So far, it looks like CrowdStrike's passed this earnings without much damage. So overall, when I look at the earnings reports of any of these companies, with Salesforce and CrowdStrike, they seem rather mundane. NVIDIA seems to be the most shocking one, that the stock isn't going crazy after earnings. And I think that's the single biggest development of this earnings season. Up until now, NVIDIA has been called the most important earnings report of the season. But I think after this earnings report, we can safely say that's no longer the case. NVIDIA is not the most exciting, not the most crazy, not the most important earnings report of the season. Now let's go ahead and move on to some other news here. We have an admission from Mark Zuckerberg. We have more clarity of what happened around COVID-19 with Facebook. He actually wrote a page-long letter to the House Judiciary Committee explaining what went down. He says there's a lot of talk right now around how the US government interacts with companies like Meta, and I want to be clear about our position. Our platforms are for everyone. We're about promoting free speech and helping people connect in a safe and secure way. As part of this, we regularly hear from governments around the world and others with various concerns around public discourse and public safety. So he's introducing the platform, saying it's for everyone, saying they're promoting free speech, and then he goes on into this letter to explain how previously, just a couple years ago, Facebook was not about free speech, and they worked in concert with the government to censor certain viewpoints and certain memes and certain jokes. In 2021, senior officials from the Biden administration, including the White House, repeatedly pressured our teams for months to censor certain COVID-19 content, including humor and satire, and expressed a lot of frustration with our team when we didn't agree. Ultimately, it was our decision whether or not to take the content down, and we own our decisions, including COVID-19 related changes we made to our enforcement in the wake of this pressure. I believe the government pressure was wrong, and I regret that we were not more outspoken about it. I also think we made some choices that, with the benefit of hindsight and new information, we wouldn't make today. Like I said to our teams at the time, I feel strongly that we should not compromise our content standards due to pressure from any administration in either direction. And we're ready to push back if something like this happens again. Now, he continues on in this letter detailing the specifics of the pressure, all the differences they made to their policies, the perspectives and viewpoints that they censored, and how they were doing it based off of limited information, and basically how they caved to pressure, and he regrets doing so. Now, I'll give credit to Mark Zuckerberg for, first of all, being transparent about this, and second of all, apologizing and saying he won't do this in the future. I think you have to give him points for at least that. He's not doubling down on it. He's not saying he's going the other direction. He's saying that he'll push back in the future, which is what I like to see. But it is scary to know that some of the biggest companies in the world will work in concert with the government to censor certain perspectives. And I think the scariest amongst that is humor and satire. He outlined specifically that the government pressured him into censoring certain humor and satire. Now, I know the defense for this, for people that are in favor of censorship, is that sometimes humor and satire can be used as misinformation. That's the term that's used. But that is very ambiguous. That's a very difficult way to manage content moderation without completely censoring certain perspectives. One of the most difficult things Mark Zuckerberg is going to continue to struggle with managing Meta is content moderation. There's no way to make every single person happy with the content moderation strategy that they implement. But I think at the very least, the content moderation strategy should not be a result of pressure from the central government. Of course, they should abide by the laws of the country, but specifically censoring different viewpoints, because of the central government, I think sets a dangerous precedent. So I'm happy to see Mark Zuckerberg moving in the other direction. Now here's a story that came up recently. The CEO of Telegram was arrested in France over a probe of online criminality. Now they say that the investigation is examining 12 potential criminal violations, including being complicit in spreading child content, refusing to cooperate with authorities, and complicit in fraud. Investigators haven't named Durov or anyone else yet as the target of their probe, according to the statement. The prosecutors said they have 96 hours or until Wednesday to hold him for questioning. The authorities are arguing that Telegram is nothing more than a conduit, a catalyst for crime, a place where all sorts of online crimes and trafficking and child content are traded online in secrecy. Telegram in and of itself doesn't seem like anything special. It's a basic messaging app that's end-to-end encrypted. So users can send messages, and if it's from one user to another, not a group message, it should be encrypted end-to-end, so there's no prying eyes into what those messages contain. So it's a basic messaging app, but it seems as though a lot of the uses of Telegram are associated with crime. All different Western governments are pointing to Telegram saying that they have a lack of content moderation. They say that it's opening the platform specifically for potential use in money laundering, drug trafficking, and sharing materials linked to exploitation, and that Telegram in and of itself is not doing enough to police these problems. Telegram says that they're doing everything they can to police these type of issues, they're working with authorities, but they also value the privacy of their users. They don't want backdoors or the government to be looking at their messages. Currently, this is one of those few stories where I haven't fully made up my mind. I want to see what he's actually charged with, what the authorities say, and how much validity there is to those charges. So as of right now, I haven't made up my mind on this, but I'll be following this case. Now, we also heard recently that the Peloton former CEO says that he's lost all of his money and had to sell his possessions. This is a story of the downfall of a once billionaire. He said before, at one point I had a lot of money on paper. Of course he had money in Peloton stock, and on paper with Peloton stock he was once a billionaire. If we bring up Peloton stock here, anywhere around here he was a billionaire. But anywhere around here, he's no longer a billionaire. So life can come at you fast. When a stock drops from $150 per share to a couple dollars, your paper wealth can vanish quickly. One of the things that he sold was his $55 million East Hampton waterfront home. He had to uproot his family, move out of the home. My wife's super supportive. My kids are probably better for it if we're keeping it real. Now I have to give him credit here. Having your wealth ripped away, having to lose your $55 million ridiculously expensive mansion can't be a fun experience, right? You feel like you've earned it, you've moved in, you feel like you're living this high life, and all of a sudden you're right back to reality. You're poor again. And even though he's going through that very humbling experience, it seems like his family's taking it well. His wife's supportive, his kids are better off for it. They probably don't care at all. I don't think little kids care that much about where you live. So overall, it seems like his family's taking it about as well as you can. Now they say the conclusion with this story is that none of the wealth is for real if it's just on paper. Stocks go up and down, and if a company collapses like Peloton, the stock price will collapse right along with it. But I think there's other takeaways as well. And one of them is being blinded by hubris. People like John Foley, who once had $1 billion of value in his assets. He once had a company valued that much, but didn't put anything set aside to sustain his lifestyle. That is hubris. Hubris is what caused him to hold on to the company through its incredible decline. That's all for this episode. I hope you enjoyed, and I'll see you in the next one.